Chart analysis. Part 3.
Indicators.
Indicators are used extensively in technical analysis to predict changes in trends or price patterns. In the context of technical analysis, an indicator is a mathematical calculation based on a security's price and volume. The result is used to predict future prices. Simple moving average RSMA is the simplest indicator. SMA is plotted based on the average of the close price. N is the period. For example, when N is set to 14, then the average of 14 close prices will be calculated to plot a point on the chart. You can use several moving averages on the chart. For example, here we have two moving averages. The red one is set to 14, and the blue one is set to 28. Moving average is a trend indicator. When the price is above the moving average, it is an uptrend. When the price is below the moving average, it is a downtrend. Moving average, divergence, convergence, or MACD, is another famous indicator. MACD is a trend-following momentum indicator that shows the relationship between two moving averages of prices. The MACD is calculated by subtracting the 26 and 12 moving averages. MACD is a great indicator to distinguish the trend reversals. In an uptrend, when the price is going up and MACD is going down, it indicates that the trend reversal is so close, and the trend will reverse soon. This is called divergence. Similarly, in a downtrend, when the price is going down and MACD is going up, it indicates that the downtrend reversal is so close, and the trend will reverse soon. This is called convergence. Stochastic is another famous indicator. Stochastic is a price oscillator. This indicator has a relatively complicated formula. Therefore, to keep it simpler, we will forget about the formula, and instead we will show you how this indicator works on the price chart. You can use different settings of stochastic. The default setting is 1473. However, you can make it faster if you set it to 533. This indicator cannot be used alone to locate the trade setups. It has to be used with the other indicators, like MACD, and also technical analysis as confirmation. We will tell you how to use this indicator to trade shortly. Relative Strength Index or RSI is one of the other famous indicators. This indicator has great features, and it can be used alone to locate the trade setups. However, Using this indicator with technical analysis helps you locate stronger trade setups. We will tell you how to use RSI to trade and make money. How to make money using these indicators. Moving average is a good indicator. However, it works only when the market trends. When the price is at the beginning of a sideways movement, moving average starts generating false signals. You will find out that you are at the beginning of the sideways market only after losing in some trades. We are not recommending you not to use the moving average indicator in your charts. You can still use them, but to be at the safe side, it is recommended to take the advantage of the other indicators, as well as technical analysis. On this chart, we have all the indicators we talked about so far. Moving average 12 and 26. RSI, stochastic, and MACD. Let's see how these indicators locate the trade setups for us. Then, to keep it simpler, we will get rid of the ones that are not necessary to be on the chart. We start with long trade setups, or buy signals. This is a long trade setup. It is formed after a resistance breakout here. Resistance breakout occurs when one of the candlesticks closes above the resistance. This resistance breakout is enough for us to go long. However, we use the indicators to have more confirmation. Indicators are good to help us have a more confirmed trade setup. Let's see how our indicators confirm this resistance breakout. When there is a resistance breakout, RSI should be already going up. It should be above the 50 level. As you see, RSI has been going up before the resistance breakout, and was above the 50 level when the resistance breakout occurred. So, our resistance breakout is confirmed by RSI. Similarly, to confirm the resistance breakout, stochastic should also be going up and above the 50 level. In this case, stochastic is also confirming the resistance breakout. In case of resistance breakout, MACD should also be going up. However, as MACD is a delayed indicator, usually it is not above the 0 level when the resistance breakout occurs. In this example, MACD also confirms the resistance breakout. As you see, it has been going up long time before the resistance breakout, and it was so close to the 0 level when the resistance breakout occurred. There is another important signal formed by MACD. MACD convergence is a very strong reversal signal. Having MACD convergence right before the resistance breakout is a big confirmation. As moving averages are delayed, they were not at the right position when the resistance breakout occurred. So, we ignore them in this example. In spite of this, all of the other indicators confirm the resistance breakout. Now, the question is, when we should have entered the market. We could buy at the close of the candlestick that closed above the resistance. The stop loss had to be set several pips below the candle that closed above the resistance. The target or take profit level can be at least 3 times bigger than the stop loss size. In this example, as our stop loss is about 220 pips, the target can be about 660 pips. This is how our indicators work. To make it simpler, we remove the moving averages. All we have to wait for is support or resistance breakout, which is confirmed by RSI, stochastic, and MACD. Support breakout,